All right, I'm back. CP3 is back. I'm not gonna go into, or at least very deep into why I disappeared for a little bit. Long story short, I needed a bit of a break. The run wasn't very long. I did like 10 videos, maybe even less. I don't actually remember how many it was. But I had to take a step back and say I was going a little too fast. But now I'm back. Trying to stay dialed. Hoping that this is gonna keep me fairly locked in. I was before, but things changed. I kind of got in my own head. Uh, you know, how the psychology of trading plays out. Today's video is going to be about my trading plan and a whole continuation model, courtesy of Cold Trades. So if anyone wants to check him out, he's a fantastic trader. Taught me a lot of the things I know today. But we're going to go and explain how I trade, based on a lot of how he trades as well. So if anyone wants to check his stuff out, fantastic guy. Anyway, I did the liberty of, oh, you guys can see that. I did the liberty of kind of writing out some sort of a guideline as to, this trading plan, and we're kind of going to go through it and fill it out. So, what pair do I trade? As a futures trader, there's not many things you could trade. You could trade commodities, indexes. There might be a few other things, but I strictly stick to indexes, and that's going to be um, NQ and ES, right? And we're gonna go into exactly which ones I do for like the specific days and why I choose them later on. What times do I trade? As in, what market open do I trade? It's gonna be New York Stock Exchange open, and that's gonna be 9:30. 9:30 to 11. Oh my God. So 11 a.m. Eastern Standard Time. I live in Jersey, so I trade New York Open. It's the most simplest thing to do. I follow the market as any other person on the East Coast does. It works for me. Some people can trade Asian market, some people trade London market. It's just this makes the most sense for me. I'm only on the markets for an hour and a half. When it's most volatile, New York Open is always the most volatile out of the three. Gives me more opportunity for entries. It just works, it's what I've always done, and that's what I'm gonna keep doing. So there's one of those things to find. At what point do you stop trading? Let me make this bigger if I can. Can I is the question. Okay. There we go. Now you guys can see it better. All right. At what point do you stop trading? For me, there's a few things that make me step away from the market. Also, if I look over here a few times, to my right for you guys still left of the screen, I have a cheat sheet. So I filled this out previously with one of my friends off camera. I'm kind of just making this video to help you guys out. If you guys ever wanted to know how I trade and what my continuation model is, and all of the parameters that I try to follow for my setups, I said, why not make this video and define all these things? So I have this cheat sheet on the side that I created earlier. And I'm kind of going back and forth here, filling in the blanks here. So, right. One of the biggest things I look for is, I'm going to number, this is going to be really messy. So I hope you guys can follow this, but number one is going to be choppy market structure, specifically on the 5 minute time frame. Not much to go through there. I guess if you guys don't understand what I mean, I'm gonna try to make this video quicker too. I talk a lot, so for anyone that sticks to this, congratulations. Because honestly, I wouldn't be able to watch my videos. You know, in all honesty, if I had to sit through this shit, I would probably hate it. So sorry for those guys that are trying to learn something. It's gonna take a little while. I kind of bounce back and forth, but if you just stick with me, I'll teach you a lot of things you need to know. So anyway, choppy market structure. What we want in a continuation model is obviously continuation. You want market structure to be continuing in one solid direction, whether that's a bullish or bearish market structure. But that is the first thing we need when we're looking for a trade is a direction up or a direction down. So what makes me get off is if there is no direction. So on a 5 minute time frame, which is a relatively larger time frame when we're doing day trading and we're zooming in, if I get anything that looks like this, any movement like this or a lot of wicks, that is when I know my time is done. I should not be in the market anymore. There's not going to be a traded take on a model that is based on the market continuing, So I'll hop off and that's it for the day. Sometimes it's going to be fairly early. It could be 10 o'clock. A lot of times Mondays and Fridays, don't really have a good yield as far as you know, ability to execute trades throughout that day. So Mondays and Fridays usually happen a lot where it just starts chopping early. It might just make one big move at 9:30, and then after that you're kind of done. So that's one of those things that tells me the market's done with. And the second thing is almost always by 11 a.m., which is why at the top I said, what times do you trade? 9:30 to 11 a.m. By 11 a.m., the market dies out. Right. So that's one of those things like, I mean, this is not to be followed strictly. So honestly, I'm gonna make this number 3. So number 2 is gonna be when we are stuck in a range. And this is already going off. Hopefully, yeah, okay. My face might cover this, so I'm gonna have to keep an eye on that. But all right, so when we're stuck in a clear range, and again, kind of the same thing as a choppy market structure, except like I said before, we're looking for something that's of a continuation, but you could kind of get into a point where it could look like we have some sort of ability to enter, some sort of a chance to make a trade, but what we're gonna have is man, I haven't done this in a while. What am I looking for? Yeah, right. Okay. You might have a 15-minute gap here and a 1 hour gap down here. This would be bearish. And it might look like the market's going somewhere, but if you could, open your eyes and identify it, there actually is no clear direction as to where the market wants to go. So it's going to be doing something like this, right? And this is a range. So there is no target for you to go any higher. There's no target for you to go any lower. You're kind of just stuck, I guess, bouncing around at what level, on one price level. And again, as a continuation model, there's nowhere to go with that. There's no trades to take with that. There's no reason to be trading because there's a high chance that you're either going to get break even or stopped out. Why are we here? We should not be trading. We exit the market. Ta-da. I also want to note that all these rules should be strictly followed, and it's not very loose unless stated so. Also, if you guys see the curtains moving, it's my cat. Oh shit! I'll show you her later on in the video. But I got a cat, little trading cat, my emotional support animal, and she's a bit of a menace right now because I just fed her. So eventually, I'll show her at the camera. But for now, she's gonna be messing around, just not behind me. So don't mind that. Anyway, yeah, when you're stuck in a clear range, do not trade. Number 3, like I said before, not as important and not to be taken as strictly, but usually a good percent of the time, say 80% of the time, by 11 a.m., the market's already dead and you're not going to find a trade. So again, that's the only rule. It's like a little bit looser, not to be followed too strictly, but keep in the back of the mind, 11 a.m., volatility is going to die down. You're going to either get a choppy market or get stuck in a range. All right. I spent a lot of time on that. Hopefully I explained it enough. Next question, when should you be on the markets? As in, when should you be staring at the markets before it opens? For me, that's 9:15. Oh my God. 9:15 a.m. So 15 minutes before market opens, it gives me enough time to identify the things I need to identify, pre-market analysis, which I'm not really big on, but the things that I need to identify in order to, continue on my trading day. So 9:15 a.m. should be on. So what are we doing for pre-market analysis? Now here's where I'm going to check out my cheat sheet because I wrote a lot. Okay, yeah. So, all right. Number 1, identify. All caps. Identify. Oh, there she is. Okay, she hopped on the desk. We can say hi now. This is Luna. She is a Mancoon. She's absolutely adorable. Okay, I'm sorry, Spirit. She kind of attacks me when I'm trying to trade, but she's fantastic. So she's gonna be messing around with the setup here while I try to do this. So if at any point I stop talking to try to throw her off, no, soon look outside. If at any point I stop talking to throw her off of the setup, you'll know exactly what I'm doing. Anyway, right. So identify strong draws on liquidity. And this is for both pairs. And when I say pairs, I mean NQ and ES. Number 2 is going to be identify potential gaps or high time frame gaps to fill. And then the third, which I hope I'm going to actually just skip it here so we don't. God, this girl. You're trying to slide underneath it with this setup. All right. Sorry. She's going crazy right now. All right. Okay. Um, right. High time frame gaps to fill. And the third being identify the stronger pair, which is probably I put this third, but this is a very important thing to do. I'm gonna go into why. I'm gonna try again. I'm trying to keep this video short, but there's a lot to explain here. All right. Yes. Identify strong drawn liquidity. Her first flying around. So again, that's not too crazy to talk about. Strong drawn liquidity. Just higher time frame highs or lows, or the gaps kind of include liquidity, so it's the same exact thing. Just higher time frame gaps. So you go in the 1 hour, the 4 hour, sometimes the daily, and you find big gaps that need to be filled, or highs and lows that are going to be swept, and you just mark them out, right? It's fairly simple for anyone that has some sort of market experience. And again, if you guys want me to explain these things in more depth, put it in the comments. And I'll do a whole video on some of these things. I had a foundation series going. I might continue that series. I might just delete it all in general. So we're gonna kind of see what direction this channel is gonna go based on what you guys say. So please comment, please talk to me. Say anything. I am lonely. Okay, identify the stronger pair. What does that mean? There is gonna be on any given day, usually one of the two things. It's gonna be either NQ or ES is leading. Now, what does that mean? When you do pre-market analysis, you're going to identify strong draws in liquidity and high time frame gaps. What is this going to tell you? The overall direction that the market wants to go within the respective time frame that we're trading. So within the next hour, you could say, high chance we're going to be bullish, high chance we're going to be bearish. But regardless whether either of them are right, which is why I did pre-market analysis in quotes, is you can't predict where the market wants to go. The whole point of a continuation model is not to predict where the market wants to go, but react when the market goes. Right, so the market is going in one direction. You catch a trade based on a pullback and the continuation of said direction. Right, that's why it's continuation model. Yes, so I have to drink some water before I kill myself here. Okay, right. So let me just do a quick drawing here. We have NQ doing a little bit of this, and then ES is doing. Right, and let's just imagine we're looking at this right as we open market, and we're looking at the hourly time frame. Is doing this, right? And this is very dramatic. In fact, I'm going to pull this back a little bit. It's very dramatic, but the whole idea is, and what we're looking at here, is that NQ has a more bullish direction, right? It's leading towards a sell side sweep. It is pushing upwards. It is looking like more of a continuation model. It is looking like the buys are, carrying the market. There's no other way to put it, right? It's looking like NQ wants to move more upwards. Now, ES here, also another thing to mention, NQ and ES are pairs, which means they move relatively similarly. They move usually together. So here, if ES is a little bit further behind, what that means is you have a higher chance of losing your trade on the lagging index. So if you're targeting highs for both of these, some are up here, let's just say, right? And if these charts were side by side and it was perfectly the same, and you take a trade on NQ off of this pullback. I know this is we're talking about pre-market analysis, but we'll say the same thing again. Take a trade off of this pullback, stops will be here, you target up here, right? This has a much higher chance of, again, continuing the movement and hitting that level, as opposed to ES over here. If you take this long, because it's lagging, a lot of the times in the markets, you'll see something called an SMT, a smart money, what the fuck is smart money technique, I think it's called. Unless I'm wrong about that, but yeah, I'm pretty sure it's a smart money technique. And what that means is when NQ creates a higher high and ES creates a lower high, or for the other way around, it could be a lower low and a higher low, right? So in short, when NQ moves further than ES does, at least in the reference of market structure. This is kind of like a weirder thing to explain. So I urge you guys, if you don't understand what that is, to look up videos on SMTs. I think I might be wrong about this, but I think I've made one or touched up on it in my previous videos. But the point here being is you don't really have to know what an SMT is, at least for this model, as much. What you need to know is just identify which pair is moving in the direction that you want it to move, right? And also, this doesn't mean that you have to plan out where market wants to go. Because let's say, it's looking very bullish and you want longs, but then all of a sudden it flips, right? So now the market flips and we're going downwards. What does that mean? ES is now the stronger pair because before it failed to make this high, right? And it is now more bearish. So that kind of just gives you a plan as to which pair to trade when the market goes either down or up, right? But just make sure you have that in the back of your mind. What is the strongest pair? Wow, that took way too long to explain. But I hope you guys are starting to understand it, starting to get it, and staying with me here. Confluences in my model. Yes, this is a very important thing. This should be more followed strictly, especially when you're starting off trading continuation, and then from there you could kind of plan out how you want to play it. But anyway, confluences in my model. Number one, high time frame draw on liquidity. And I'm gonna do high time frame / strong draw because sometimes you have strong draws on relatively lower time frames. Number two, we are gonna have what's called a gap tap, which is either on the 15-minute or the 5-minute time frame. And number three, displacement candle. Or in fact, I'm gonna do strong displacement towards draw or rejection of pullback. Now this is a lot, but I'm gonna explain this or try to. I'm also noticing that my head is getting in the way, my fat head, so we're gonna move myself over here. Right, what does this mean? So if I could hopefully work within the space that I have here. Again, continuation model, we're gonna use a bullish I guess example for this. So if the market is moving upwards, right? Ding, 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 ding. And there is continuation of this movement, and the whole day you're planning on it being bullish. Again, we're not doing planning, but if you're seeing reactions to these things, that is when you want to take a long. I think I'm getting allergies from this freaking cat. Her hair's going on my nose. Anyway, I'm gonna try not to sniffle here. But yes, so you're going up, you get a pullback, you're going up, you get a pullback. Now on the 5-minute time frame, oh sorry, first of all, I forgot to mention, right? Market's doing this, and on the 1-hour time frame, you have this high, or even better, let's say all-time highs. The market is moving towards the highest it has ever been, all-time highs, right? And we're gonna mark this out with a ray here, right? Let's just say hypothetically, the market was at an all-time high over here. So previous day or last week or whatever you want to call it, the market was there. And now we are tracing back up to these all-time highs. Very strong draw, right? So we have now identified a high time frame strong draw. That is confluence number one, right? Now what do we need? Some sort of a gap tap. What's a gap? A fair value gap, right? If nobody knows what that is, you should probably not be watching this. You should be watching videos starting to explain to you slowly how to trade. We're introducing you to simpler confluences because this is more of putting things together, right? So for this, I guess I didn't mention this at the beginning, but this video is more for, I don't want to say advanced traders, but people that have some sort of understanding of what liquidity is, what fair value gaps are, strong draws are, some displacement, rejection, opening and closings of markets. You know, these things are kind of needed to understand what I'm talking about. So at any point, if you're here saying like, what is this? What is that? Either do what I did when I was learning, when I watched these, more complicated videos. I'd write down every word that I have no clue what they're talking about, and then watch a completely separate video about what that means and make sure I truly understand what that means. Watch multiple videos of that if need be, and then return back to the original video and go over it all over again to really put the pieces together. Because at this point, it's like a puzzle, right? I don't know what you know, and I don't know what you don't know, or what you know and what you don't know. I don't know what you don't. You get what I'm saying here. I don't know what you know, so I can't run through all these things because this is a lot of stuff that I've learned within the last year and a half, right? So I can try to put the pieces together and show you what I understand and how I trade. But at the end of the day, there's some things that you have to either learn yourself from other videos or, learn from me or just know now as I'm explaining it to you. Anyway, again, big yapper, but we're back to it, right? All-time highs, very strong draw on liquidity. Now what we're looking for, a gap tap. So let's say market's moving, but we haven't had much of a gap tap. And in fact, I want to make this even simpler, right? Let's just say the market rocketed upwards, right? And then it does a little pullback into a 15-minute gap that we have right here. You can even say 5 minute. 5 minutes more realistic. You don't really go into 15-minute gaps that often. So 5-minute gap right here, right? I'm gonna lower this text a lot. 5-minute gap here. Hopefully you guys can see that. If not, just know this is 5 minute. So high time frame draw, gap tap. And now when we zoom in on the 1 minute or even the 5 minute, you're gonna see a candle that just really moves towards that direction. In fact, it's gonna reject everything that happened here, right? I want to also preface this. Every time the market makes a move upwards and there is a pullback, there is an equal opportunity for that pullback to now be a reverse. So you say, Eric, why don't you just limit the gap here, right? As in like a limit order in the market. So the second it hits the gap, it enters you in. And then you long there, is because at any point that could inverse the gap and then go downwards. You don't really know when the market's overextended, even if you do have a high time frame draw and you're very close to it and it's very obvious the market wants to go in that direction. I am looking for extra confirmation. Now, what does this mean? I trade significantly less often than people would if they were doing limit orders on those gaps, right? If you just put an algorithm into the market, how many times are there gap taps in the market? So many. Either the 1 minute, 5 minute, 15-minute time frame, it happens so often. Now, what makes it different than mine? We need two other things. There is a high time frame draw, which a lot of times there isn't one, and another one is a strong displacement towards said draw on a lower time frame. So yes, you're not going to trade very often. Yes, this takes patience. Yes, you have to kind of have discipline in the market when you're looking at these things. But when you do, you're going to become consistent. You're going to get payouts. What was I saying here? Right. So you tap into that gap, right? You could limit it if you wanted to, but at any point you could just reject it and dump the market. So here we are. We tap into the gap. Now, in the 1 minute, you get this big, juicy candle, right? That just pushes upwards. So all this moving downwards now gets flipped and we get one candle that moves upwards. Now, how do you know that you have a nice rejection candle? What I like to look at is the number of candles made or number of candles printed to make the downwards movement or the opposite movement or the pullback movement compared to the number of candles needed to make the rejection of the pullback. Has to have some sort of, not ratio, but like it should be very obvious to you, right? So let's just say we have this here, boom, right? It pops up. We have a nice displacement and then a pullback into the 5 minute gap, right? This pullback, we could say, took 5 candles to make, right? It took 5 candles. They're a little wicky, 5 bearish candles, but they slowly made their way down. And then the second we hit that gap, or a little like another minute after we hit that gap, we get one big displacement candle that closes above, the last 4 candles, right? It closes, and one singular candle, it closes like this, real high, right? That is your call. I mean, obviously, discretionary trading here at this point is like, how close do you want to be to this before you start top banging this trade? But right, you print up here. That is your call to say, yes, I now want longs. And the stops are going to be right here. And we're going to go over stops later on. Stops are going to be right here. And the profit's going to be at the high time frame draws. And break even, we're going to set our profits to break even when we cross this high, right? So obviously I kind of drew this poorly, but you get the idea. Right, that's the whole idea of our trading. High time frame draws, gap tap, strong displacement towards our draw that rejects a pullback. I'm going to delete all this. Hopefully you guys took a chance to draw that. If not, just go back and pause the video because that's what we're going to be looking for every time we trade. Anyway, how many trades per session? It is always going to be one for me, at least when you're starting. I still consider myself a beginner. I've been trading for 1.5 years now, but this exact model I've been trading for about 4 months. So, or maybe even 3 months, maybe even less. So I'm still a beginner. I'm not going to be going out of my way to take more trades. I'm not going to be doing more discretional trading. I'm still sticking to what I have drawn out here, the basics, right? That's all you have to stay with. Now, unfortunately, what happens is the last 2 months have been very poor for me as far as finding trades go. I think I had a drought of a straight month of not trading at all. Even though I was looking at the markets, being attentive in the markets, I found, I think, one singular trade that was a very good setup and it still ended up being a loser just because summer price action is completely terrible, right? And that's what you expect a lot of the times, right? Price action isn't always going to be good. Not to mention Trump in office now, it's a little unpredictable. So it's been rough. It's been tough and it's been rough, bars. But right, you have to have patience, you have to stay disciplined, and you keep moving on because there's going to be times where you're going to see the market absolutely bang when it comes to these things. Like continuation models work. They really do work when the market is moving. And that's shorts as well as longs, right? I'm showing you a lot of longs because they're easier to understand, but it works when you flip the market as well, right? You just need a high time frame draw on the short on the buy side. You need a gap tap into a 15 or 5 minute bearish gap, and then you need a strong displacement towards that gap, or sorry, towards that draw, through that gap. Or I guess out of that gap towards your draw. Sorry, forgive me. Anyway, how many trades per session right now? One, right? You're starting off just one trade. You lose, get off. You win, get off. You're done. All right. Maybe you could discuss it when we talks about break evens. When we go break even, maybe you could take another trade after you walk away from your computer and take a breather. But for now, just one trade at a time, right? And honestly, my average for like a decent month that has a decent price action is going to be 2 trades per week. That's what I look for. And I'll be happy if I hit that, right? As long as you're staying consistent, right? It's not about the amount of trades you do, it's just the quality of them, the win rate, and if you're staying consistent. All right. What do you do during high impact news? Absolutely. Wow. I might have spelled that wrong. That'd be really funny if I did. All right. Nothing. You do nothing, right? High time frame news is coming. High impact news is coming. Red folder, orange folder. For those who don't know, you go up here, you type in Forex Factory, bam, and this is going to tell you all the news you need to know on the current day that you're trading, right? So high time frame news is going to look like this, right? Red folder on the USD, ISM, manufacturing, PMI. That means on Tuesday, September 2nd at 10 a.m., I will not be trading. I will be trading at exactly 10 o'clock, right? After that happens, 5 minutes later, maybe I'll take a look at the market and see if there's an entry. But 5 minutes before, I should not be in a trade. During that news, I should not be in a trade. And 5 minutes after, I should not be in a trade, but maybe potentially looking for one. But during high impact news, do nothing. Moving on. What are our targets? What are we trying to target? Like I said before, high time frame draws, high time frame draws and liquidity, right? That's our targets. So anytime you do any sort of take profit, it's always going to be at that level. Why won't you go higher, Eric? Why don't you want to target higher? For any of those that understand how liquidity works, a lot of the times you're going to get that level hit and then the market's going to flip, right? The orders have been filled from that level and now the market is going to go in the opposite direction. That doesn't always happen. You'll have times where the market overextends and keeps going in that same direction, at which point you may be able to take another trade to a different draw that's even higher, even lower. But always set your take profit at high time frame draws and liquidity and no higher, and no lower unless there's some sort of circumstance that makes you want to pull out of the market earlier. Like if you're very close to passing an account, then you might as well just pull out early instead of risking the market flipping on you. What are our stops? It's going to be recent lows. I'm going to see exactly what I wrote here. Yeah, recent highs or lows, depending on what trade you are. For the example of longs, it's going to be recent lows. Shorts going to be recent highs. So recent highs or lows. And I actually have multiple answers here. Yes, okay, yeah. So what are our stops? Recent highs or lows, and that's going to be the end of our stop loss. But what do you want between your entry and your stop loss, which is very important, which is actually more important, is you don't want to be entering out of thin air, right? You want, again, like we said, a gap tap that's going to give us something to protect ourselves from a stop loss, right? So more important is going to be, on some asterisks here for you guys to really understand this, is going to be some sort of protection. 1 to 15, or I guess 5 minutes more reasonable. 1 to 5 minute FEG, IFEG, or in the best case scenario, a BPR. Again, if you don't know what that is, find another video to explain it to you. Maybe find one of my videos to explain it to you. But you want something stopping price from going from your entry to your stop loss, right? So in case that level that you now entered on gets retested, you have some sort of opportunity to still be in the green and have the market move in your direction that you wanted, right? And if it goes through, then tough luck, that happens. You're not going to have 100% win rate in this game, so don't expect it, right? There's going to be times where it just runs your stop loss, even if you do have protection there. But the protection is going to greatly increase your win rate as opposed to just entering on one candle that made you feel good. So anyway, when should you go break even? Around 0.5 RR, right? So roughly, very, very roughly, but I'm going to show you what that means real quick, right? Continuation, you take the long, right? Where's my Okay, long position, you take it along here because you have some sort of displacement out of the gap here, and you target some sort of high time frame liquidity up here. Now, a lot of the times, my RR, my average RR is like 1.3, I think, right? It's like 1.3. Now, yes, people always stress RR on social media, say your risk to reward should be 2, should be 3 per trade, 4 per trade. What does that mean, right? Risk to reward means nothing if there is no context behind it. I stress this a lot for everyone that's starting to trade. I could have, realistically, my trades be 20 RR. Every time you increase your RR, the probability of your trade hitting now significantly decreases. Why is that? Is because you're now setting unrealistic stop losses and take profits. So let's say we have this realistic draw up here, bang, right, that we're looking to hit. We have this low that we set, and this makes us 1.2, I don't know if you guys see that, but it says 1.27 RR. That is the risk to reward of this trade. And that would be perfectly acceptable, right? And I know I'm going on a tangent here because we're talking about break-evens, but I'm going to get to it here. This makes it perfectly acceptable. Now, if you want these trading gurus to talk about 2RR, 3RR, 5RR, what is that going to look like? Instead of having this protection that we had from this 5-minute gap, which I'm going to mark out, or a 1-minute gap, or even an inverse here, we have some sort of protection here. Let's just say it's a BPR, right? We marked out the inverse, and there's a fair value gap right there. Now to make it, that trading guru key level 4RR, what do we have? Yeah, we have 4RR right now, but no protection. So at any point, this could come and retest this gap, and you no longer have your stop loss setting at a reasonable level to protect you, right? Yeah, your RR is 4. Yeah, sometimes this trade is going to hit, and it's just going to blast on through, and there's not going to be any drawdown. But the times where there is going to be drawdown, you're going to lose a lot of time. Your run is going to decrease significantly. So be realistic with setting your stop losses. Set them realistically, not this close to your entry, right? Give them some space to breathe. Again, also don't set them down here, right? One, you don't really want to be below 1 RR. That's kind of stupid. You're risking more than you're willing to win. And this just doesn't make any sense, right? If we've swept this, we're kind of just completely breaking market structure and going to the downside. So here's going to be the realistic target. And take profit again. Yes, what makes your risk to reward bigger is a smaller stop loss and a bigger take profit. But if this is a high time frame draw and we're targeting all the way up here, and this is 10 o'clock, 10:30, what are the chances that we're going to run all the way up here, right? This makes a 4R right here. What are the chances we're going to run all the way up there? Very low. In fact, there's a high chance we're going to sweep this, right, and flip. So instead of going the direction you want it to, we are now going to go limp dick back to either break even or your take profit, right? So instead of being greedy and losing this trade, you could have taken profit up here, been up on the day, and walked away, like we said, 1 trade per session. Yeah, that's kind of it. That's I went on a tangent here. Oh, sorry, the break even, right? So going break even, you want your break even to be 0.5 RR or around there. I think I drew it out. This is kind of a rough representation of it, but right, you want to go break even when we sweep a recent high or low, right? So our targets are obviously higher because we're continuing the movement. We want the movement to continue upwards. But this recent high that we made here is going to be our stops. Why is that? Because this is also a sweep of liquidity. And what do we know about sweeps of liquidity is there is stops set at these levels that whales want to fulfill that could potentially flip the market. Right. So at any point when we cross this level, you're probably most likely going to see a pullback unless we have such a strong draw just bust through. But we could see a pullback here and then a continuation, or it could completely flip now that we hit this level and go completely downwards. Right. So there's a few ways that markets can play out. This is one of them. So what do we do to protect our asses? Is by the time we sweep this level, we are now closing stop loss right to where we entered. So you are no longer at risk of losing a single penny. And now sky's the limit, right? You either take profit or you walk away in the day and make nothing. But you have a breath of fresh air now because there's no longer a chance of you losing. Now, what does it lead to? A lot of times, I wouldn't say a lot of times, but there's times where you might get stopped out at break even and then it's going to continue and take your profit, which sucks, right? And this kind of goes down to one, like setting your break evens discretionally. Like if you know the market's being a little bit more aggressive on this pullback, so there's a higher chance that it comes back to you. Maybe wait to set it to break even, or maybe trail your stop. Maybe don't go all the way to break even right away, and I can't do this right now, but maybe set it a little bit higher in the fair value gap, right? Or if we've created more protection here on this rejection of this pullback, maybe there's a 5-minute here now, a little bit higher. And now you could set your break even, not, it's not gonna be break even, but you can set your stops somewhere here instead of all the way at the bottom here, right? So it's kind of just like an idea of protecting yourself. But for the most part, I don't manage my risk until it comes to, sweeping a high or a low recently and moving to break even. So like one of these things. And then that's when I set to break even, and that is my position management, and I step away, right? And then it's either take profit or break even from there. Unless I get rejection of these highs and there's like some sort of SMT being created, at which point I might just, close my positions before I even hit my full TP just to secure some money. But yeah, for the most part, that these are all like one-off times, like the 1% of the time that this will happen, right? For the most part, do this and you will be more than fine. And again, the more market experience you get, the better you're gonna get at this, the more you're gonna see this happen in real time. And I'm probably gonna make a video, maybe even after this one in a few days, uploading it and showing you guys, in back testing how this is, played and how you actually see it. But, just purely hypothetically, this is how it's going to look like, setting your break evens, and all that jazz, all that fun stuff. Ooh. Anyway, yeah, I spent way too much time on this, but you get the idea, right? Where break evens go, what they are, why we're doing them. All right, add-ons. Not much to talk about here. I'm going to make this very quick. It's not as advanced as you might think. Maybe I shouldn't have deleted that. But basically, if you see another setup inside of your current setup while you are, in profits, I definitely shouldn't have deleted the last thing, but it's fine. Yeah, while you're in profits, you see another one of your setups. So high time frame draws, some are a little bit higher. And then price, that does one of these things where it pulls down again and then goes. So there's like 5-minute gap here. So you're initially entered off the top of this gap. Yeah, I'm gonna draw this as fast as possible so you guys could get out of here. But yeah, 5-minute gap here. There's another 5-minute gap here, and you do the same thing you did here. Tap, continuation to this high time frame draw, and you enter, right? The first time, right? Money's going well, we're doing good. Oh, another pullback. Okay, hold on, we're already break even here. We've already gone break even. Also, this stop is wrong. The stop would be like right here, probably be somewhere here. Anyway, you go break even, and now pull back, and you tap into the 5-minute, and then displace again. Then you add some more positions here for a long, targeting the same take profit you were before, and your stops are still going to be break even, right? But break even is not going to be here anymore because you entered a little higher. It's probably going to be somewhere in the middle, depending on how hard you add in. It's as simple as that, right? Trade's going well. You already break even, and you now saw another entry, another chance to take the setup. Because again, continuation models are going to have that. If we're doing a continuation phase, you might continue within your trade add on, right? Just market, buy, bang, you're in again. You're in for heavier, and you're in for more profit, and you're going to see more green. Yeah, that's what we like to see. And that's kind of it for. I don't think I missed anything. I mean, for the most part, this explains a lot of it. This is the whole trading plan. We'll zoomed out for you guys to see. If there is any questions, put them in the comments. Say something, say anything. I'll answer you guys. Talk to me. I love to be spoken to. I like to have conversations. That's kind of it. So thanks, guys, and I will see you hopefully in the next video. Maybe not. Maybe I'll just disappear. Fuck. I'm thinking about doing videos like a little less often than I was doing before. I think before was a little ambitious. I'm gonna try doing trading recaps. So anytime I take a trade, I will do a recap. So that's gonna be hopefully 2 times a week on average. If I have some sort of video where I explain my model, go more into depth about some sort of confluence that I have, or if you guys have any questions and I'm willing to answer them in video form, then I'll make more videos on that. So I guess we're gonna just play it by ear and see where we go. Anyway, thanks for watching. If you came to the end, you are a real one, and I will see you in the next video. Thank you very much.